I'll tell you a bit about my story, why I set this up. And in fact, here's the just share the screen here. There's obviously investor, champion investor. That's the league table. But you can, like I said, set up your own mini leagues. I don't know if you've done that yet, but if you own thing, you just and if you go to the blog, you can see how to do that. It's very simple. Mini leagues, so you can set a league up for your school or college or whatever.
Yeah.
But the reason why I set this up, well, I don't know if you've looked at the my video before, but years ago, like, so when I was at A-level economics, and I found it, it was a subject I chose, but I found it quite dry and quite sort of boring-ish. And then all of a sudden, towards I think it was at first end of the first week, my teacher had said to me, "We're going to start a stocks and shares competition, a fantasy stocks and shares competition." And this was, you have to understand, this was before internet. That makes me seem so old now, but it was before the internet. And so he thought, well, how are we going to do this, sir? I said, my teacher, I said, well, how does it work? And he said, well, you have £1,000 and you have to invest in different stocks in the stock market. And I thought, well, are you going to give us £1,000? And he said, no, it's pretend money. I thought, oh, that's boring. So we went up to the library and there was an old copy of the Financial Times on the table, like yesterday's Financial Times. That is as high tech as it got.
Mm.
But literally, we started doing this, and I got almost hooked from that day. I remember that day, literally looking at the way to check stock shares then was on teletext, which was like a screen on TV that used to refresh every sort of 5 minutes and go around loads of companies. And if you missed your company, you have to wait another 10 minutes. But from that day, I was actually always, hooked on investing. And I thought, and I sort of realized from a young age that if you want to create your own wealth, if that's what you want to do, I mean, you shouldn't just make money for the sake of money, but by enjoying it as well. I mean, there's two ways to do that, I believe, and that's set up your own business or invest in a good business, and you can earn lots of money in good jobs, of course you can, but I'm talking about your own wealth. So when you're working for someone else, you're getting paid by someone else and they can get rid of you when they want. If you start making your own money, you'll be almost financially independent. The sooner you start learning that, the better, because it's your money and your money can earn money for you. And so that's a compounds over many, many years. And like I said, I went through so many jobs by the time I was 25. I counted 25 jobs. Part of that was I went traveling around Europe and I worked as a melon picker in Israel. I worked in a nightclub in Greece, but I've always loved investing. I came back to it. I went through a series of low-paid jobs. I finally got into radio and started earning half decent money, and I started investing in the stock market. And I remember going back. The first time I started making decent money was in the dot-com bubble. Now, this was when everything was going to the internet. The internet was the new thing. And so everyone said, James Moore's just joined. There we are. Welcome on, James. I think it's James there. Yeah, so when I started making money was in the dot-com bubble. Now, it was a crazy time when it was like the AI now, but it was worse back then because, AI, we are further along the sort of development curve of technology, but, the internet was completely new. And you'd have companies just change their name to .com. They put .com on the end, and the share price would double overnight. And so literally you couldn't lose money. And then people are saying it's a bubble, it's ridiculous because the valuations of these companies are ridiculous. They're so high and they don't earn any money. And I didn't, as a new investor, I didn't care. I thought, I don't care, I'm making money. And then all of a sudden, one day the bubble popped and I lost pretty much all the money I'd ever invested, and I had to go back to working in low-paid jobs. And then I went through that for a period of time, and then a great financial crash happened. I invested in a Lloyd's Bank. I did very well, and since then, it's done very well for me. In fact, Lloyd's Bank. Let me tell you about the great financial crash. So I started earning decent money. I moved, and the great financial crash happened. I lost my job. I had money for a mortgage deposit. My wife had just become pregnant, and I didn't have a job. I thought, right, I need to double my money. And this is not the right way to do it. This is the wrong way to do it. I need to double my money. I'll do it in the stock market. This is out and out gambling. It's ridiculous what I did. I put my entire mortgage deposit in Lloyd's Bank. You've probably heard of Lloyd's Bank. It's one of the biggest banks in the UK. But at the time, it was a banking crisis. Banks were going bust. But Lloyd's Bank had dropped by like 60% the share price. And I thought, it's got to be okay from here. It's got to do well from here. So I put my money in fact, half my money in. The next day it went down by 33%. And oh my word, that's my mortgage money. So I sort of started to think about it, and I thought, okay, what do I do now? I didn't tell my wife to be, by the way, it was then. And I decided to put the rest in. It went down by another 20% next day. And literally, I had sleepless nights. It was bouncing around the share price, going nowhere, up and down, up and down. And so I thought I'm going to either pull this money out because I've lost enough money and I can't afford to just lose any more. And then one day it just started rising. And after the great financial crash, which was the last, we're now in a bear market, by the way. A bear market is when a stock market has gone down by 20% from its highs. So it's now is a good time to sort of invest because we're at low. That was the last sort of big sort of bear market. And that was 2007 to 2009, lasted 2 years. Generally, the stock market will do like, 5 to 10 years in a bull market going up and around about sort of a year to 2 years going down. Obviously, no one knows when that happens because, and normally they come after a big bull market. So everyone believes it's going to carry on going up all the time. And but it doesn't. So anyway, the great financial crash, it recovered, and I vowed from that day I'd never ever take that kind of risk again. But I did manage to make money back. I pretty sort of double or treble my money. And from that day, I thought, okay, let's do it properly. And I started looking into investing it and learning about it. And I've got to say, it's if I hadn't, I got a passion for investing because I genuinely believe if you want to create your own wealth, you can. And there's very few ways you can do that. I mean, you can win the lottery. That's not likely to happen. You can get a really high paid job, but like I said, you are beholden to your employers. Or you can invest, and you can do both. You can have a good job and invest, and in that's the perfect scenario because you can earn good money, invest the money, and the money will earn money for you over time. And like I said, in all the years, I have had an excellent sort of, I say, what, 13 years investing. I started in about 1999, but seriously since 2009, and I've done very well over the last sort of 10, 11 years. And like I said, if I'd added up all the jobs I've done, I'd probably earn more investing than I have in the jobs. And so if it goes well, it can go very well, but it's like risk and reward. It's like anything. You can invest in safe companies that give you a decent, nice return, or you can go a bit riskier and go for a bigger return, but there's a chance you may have a little bit of a fall. But there's different ways to deal with that. Like I said, there's diversification. You should never put all your money into one company. You could try and go for a different kind of, and I talk about this on the blog. There's a couple of videos on this. Check that out. I mean, the guy who's at top of the page here, he put his £100,000 in a biotech company, very risky because it's what's called a sort of a loss-making company, pre-revenue. It's not earning any money. It doesn't sell anything. It's just basically testing a drug. It's got a drug or a system that will hopefully sell or license out to a bigger pharma company for lots of money. There, the test results come out that showed what they had was quite good, and it shot up by like 200%. And he put all his money into that. Now, that could easily go the other way very quickly. So luckily, I think he's taken a bit of profit. But investing is about risk and reward. It's about saying, how much am I prepared to risk? And by that, you should always think worst case scenario. If I put this money in, I could lose it all. Am I happy with that? So never invest anything you can't afford to lose. And then realizing, is the reward I'm hoping to get worth taking the risk for? And so you have to weigh it up like that. So if I was you in the game, you have, you can have five companies at one time. I would spread your risk a little bit. So you may want to go for bigger, older, well-known companies that won't be as volatile, but may give you a nice 5-10% rise, and then go for maybe a bit more risky. And you can take a bit of risk because it's just a game. When it comes to real life, you realize you can't take that kind of risk. But then you go for smaller companies, and you're thinking, well, how do you tell the difference? And what is it? But largely about size. The big companies, the biggest companies in the UK are literally called the FTSE 100. That's an index of the biggest 100 companies on the stock market. And they are very well-known names. Like I said, they are the Barclays, the Lloyds, all those kind of stocks. That very good businesses, very mature, making lots of cash. They pay dividends. That means just for investing in them, they'll pay you a certain amount of money every 6 months. And then you get the smaller companies that are, say, pre-revenue, loss-making, but they've raised money and it's more of a story. When's the next bit of news coming out that'll excite investors about the potential? So the smaller companies is more about potential, the potential of earning future profits in some way. Whereas the bigger companies, they are earning profits. And so, it's how much profits they can earn. So it's a lot more stable. But yeah, I would just say, have a play around, search for companies, ask other people. And it's just a learning process. Like I said, the sooner you can learn about this, the better, because it's one of the ways that will make you financially stable if you do it properly. I mean, and in fact, what I advise people starting first time out, proper investing is to invest in a fund, and they are less volatile. What a fund is basically, and there's lots of different types of funds, but you can make one investment and that will diversify across like 100 companies or 1,000 companies in one go. And a couple of companies are very good, Vanguard or BlackRock, for example. But that's a sort of Vanguard, for example, you can have it index. So I'm invested in what's called a FTSE 350 index, and that means it's a little fund, not in the game in real life. A little fund that's one of my investments. I'll put my money into that fund, and literally straight away, it buys 50 companies that pay high dividends, so you get income as well. So straight away, I'm diversified across 50 companies. So when I talk about people starting to invest, start with a fund. They're not very volatile, but they're quite a predictable, return. And then once you have, a couple of years, 2, 3 years under your belt, maybe start researching. Well, start researching straight away, but then start investing in individual companies, because that gets harder. And then here's the stats. Okay, we just did a month now of Champion Investor, and 78% of people who are playing this right now in the first month are losing money, and that's individual companies. That's how hard it is. But a lot of people make big mistakes, obvious mistakes. Like they take too much risk. They go for very risky stocks on their own, and they put all the money into them. You shouldn't do that. Like I said, if you diversified across 5 companies, some of them are mature, some of them less mature, then you probably wouldn't do that. But so it's silly risk for that. But I mean, yeah. So just have a play around. If you've got any questions, like I say, I'm here. You can send me an email. If you're trying to find a company or thinking of a company, yeah, I'll let you know. But yeah, but asking you guys and girls out there questions. Do you know what you're doing? Do you know what you're looking for? How do you find ideas? Have you started investing yet? Anything? Let me know some feedback. What's your thoughts so far? Anyone?
So how do you like know what stocks to invest in?
Good question. Well, I tell you a good website actually. I produce uh videos and podcasts for this company. In fact, this is a company here of a live video on YouTube. This is John and I who are, where are we? That's John, and we talk about stocks on a regular basis. So foxmarkets.co.uk is a good place. We largely focus on smaller companies. So they're a bit more risky, but of course they can give you a bit more reward. There's another one here, Hot Stocks. Paul and I. Paul is an equity analyst. That's his job, to analyze equities. We have a big discussion. We have a heated discussion at the start because he's sitting on a company that's come out with a profit warning, and that company's share price dropped by 30%. And I said, well, you can sort of see that coming to a certain extent. He's staying in the stock. My rule is this: if you're in small cap companies, and this may sound counterintuitive, but there's 2 reasons why private investors lose money. Now, in the real world, even 70% of private investors lose money investing in individual companies. Okay, so not in funds. Funds are quite relatively safe. You're going to have to do quite badly to lose money in the fund. But private investors lose money pretty much. Only 30% make money consistently. And one of the reasons, or 2 reasons why private investors don't make money is they go too big on a position and hold the loss too long. So first of all, don't go too big. If you've got, let's say, fancy stocks and shares, for example, if you've got £100,000, don't put £100,000 in one company. Put like £20,000 in one company, £20,000 another, 20,000, and 5 sets of 20,000. So if one bombs, if one of them gets cut in half, that's only a fifth. It's only half of a fifth of your portfolio. And of course, if you held £100,000 in that stock and it dropped by half, that's 50% of your money gone straight away. So it's almost like accepting you will have some losses. It's going to happen. Now, if the losses get too big, they can drag your portfolio down. So my rule is, if it goes down by 20%, I cut my loss. That's rule number one that private investors do. And that, it depends. If you're in a bigger company, it's not too bad because they are a mature business. But new businesses, they can go wrong. So it's a lot riskier. And secondly, it's not cutting your winners. So when you get a winner, and it keeps winning, you find momentum carries on for as long as you can think. So it's almost like, look at it sort of target, like I'm going to make 30, 40, 50% on this. And then if it drops below that certain level, I'll sell, but never sort of sell if it's going up because momentum can carry on. So if you've made a mistake, keep it small, cut it quickly. Um, if you're on a winner and it's an obvious winner, it's doing very well, don't cut it. Only cut if it stops dropping back, like for days on end or something. But I mean, those kind of winners can go on and go on and go on. They can transform a portfolio. But yeah, I would check out Vox Markets. We talk about lots of companies here. Like for example, we talk about quite a few big companies on here. So, but yeah, I'm going to add a bit to the website as well soon, which is most traded stocks, so most stocks sold, most stocks bought. So you can see the kind of stocks there, but also on the website you can see, what people are trading here on last trades. I've got to be logged in for that, but I mean, I'm not logged in. You can see what people are trading, but it's essentially, you get to know that. Like when I remember when I went back to investing, and we did our fancy stocks and shares when I was in economics A level. We literally were presented with this Financial Times. It was like 4 pages of just text and numbers. I thought, what the heck is this? How do you make any sense of this? And it's just looking up and down. So you literally look at companies, and that, we didn't have the internet back then. So you can look at, anywhere, just go around, just search for companies, UK small cap, or and when people say cap, it's about market cap. Look, I'll show you something now. So, for example, let's have a look. So, if you go on, let me just type in a company here, like SBDS, right? This is a company called Silver Bullet Data Services. If you're on Vox, you do that, then it'll give you go to the company page, and this is the bid and ask. This is the spread basically, and this is the market cap. Okay, now, that's called market capitalization. That means that shows you how big a company is. Now, 29 million may sound like a lot, but it's not. It's what's called a micro cap or nano cap. It's very small. So you took about FTSE 100 companies are 4 billion, and so what that means is every company has shares. Obviously, you can buy and sell. Now, the amount of shares they have in issue multiplied by the share price gives them market capitalization. So let's say a company has 1 million shares in issue, in the stock market, and they're £1 per share. Then, of course, that's a £1 million market cap. If there are 100 million shares in issue, they're £1 a share, 100 million market cap. But generally, anything below 100 million is quite small. And then you go sort of from 100 million to 500 million mid cap, and then 500 million maybe to billions, they're sort of larger cap. But I mean, so you want to mix those size companies up really, and maybe even go for different sectors. So, there's no point going for all companies or all banks, for example, or all companies selling clothes, like Asos or Boohoo or whatever they are, So you want to mix it up. Say we go for a company doing holidays, a company doing a bank, and so mix up the companies you have, mix up the size of companies you have as well, and it'll help stabilize your portfolio. The aim of the game, I mean, it's not to win this. That's not the thing. What you need to do is try not to lose money. Okay, and that's the thing. That's not as catchy though. Try not to lose money.com as champion investor. So if you can finish this year and you've gained on your money, that's very good. You are beating 70% of the people out there. Okay. So just think on that first. How do I not lose money? And that's all you sort of need to do. Okay. And if you can do that, you'll do well. But yeah, check out voxmarkets.co.uk and type in a couple of companies. And if you sign in, you can create your own watch list here. Yeah, there's some of the companies I own in real life. And these are the prices today. But yeah, we talk about lots of companies, but just doing research, just do research. I mean, if you're reading, what about investing? If you're reading the newspaper and you see something that's doing very well, like themes that are doing well, like you say, or if you're reading the paper that, the UK TV and film industry is doing very well, okay, so who's in that? Which companies are listed on the stock market that have exposure to that sector? So you can sort of go in that way. And if you see, areas that are having a hard time, like maybe leisure at the moment, restaurants, then maybe avoid that sector then. So, don't look for companies in that sector. So like it's very much about, investigating. That's what it's about, and if you become very good at it, it's like anything. If you become very good, you can make lots of money. But that, and it's also related to how much work you put in. So if you have a passion for it, it's not like work. You'll do very well at it. It's like anything. There's best sports stars in the world. They have talent, but they work very hard. And in fact, with investing, you don't need that much talent really. If you had talent and worked hard, you do very well. But if you work hard and just have a passion for it, you will do well. And if you do well, you could probably earn more money in this than your jobs. And so that's nice, isn't it? It did be like that. So yeah, so it's about that. So hopefully, I've inspired you to sort of get out there and find some stocks. But don't you can send me an email via teacher or anything like that if you need any help, any advice. But like I said, I'm just picking stocks here and there. I do lots of research. I got detailed spreadsheets that I go through when I look at companies. But I wouldn't put those up, but they'll bore you. But in fact, I will bore you with a spreadsheet. So here's a company, right? I bought this company. I invested this guy over a month back. As yet, it's not paying out. But why I quite like it is it they are. I don't know if you've seen these shops now. Everyone's saying it's a cost of living crisis. And everything's quite hard. So these are the kind of spreadsheets I'll put together, and I'll be putting these on. So this is. I'll show you. In fact, let me go here. That's the figures I put in, but it gives me the scores. So it literally, I look at growth, value, health, efficiency, momentum, and potential, and I literally they get scores for every one of those metrics. Here's a company called Ramsden's I've invested in. It's a 61 million market cap. It's got enterprise value 55. That means it's got about 5 million in cash because that's what you buy it for. And it's got revenue profit there. And I break it down. I input all these figures and I literally break it down into a score like that. But that's kind of the search I do. But this is quite a nice little business because it's what they do is we're in a cost of living crisis, and what they do, they are a shop that does pawnbroking, so it's loans basically on people's assets. So if people come in and they need some money, and they got a nice watch, say, listen, I need some money quickly. Can I give you this watch? They will loan you money on that watch, but you have to come back and pick it up within like 3 months, or they'll sell it, not without your permission. But as they earn money off that, they also buy gold. Now, gold is going to go up in price because interest rates will be coming down hopefully this year, which means the dollar will get weaker and every commodity is denominated in dollars. So when that goes down, probably commodity prices sort of tend to rally. Gold will tend to rally, and so they buy and sell gold. They also buy and sell jewelry, but they do loans as well. So and they've got 160 shops in the UK. They get expanding to about 300 shops. Like I said, very healthy balance sheet. They've got plenty of cash. They're profitable and they pay a dividend. They're not a super exciting, sexy stock, but I think they've got good growth coming. And I'm predicting that will do, next year, 51% based on multiples of their earnings. So 51%, I'm hoping they'll do this next year and over the next couple of years, 66%. So another one is quite nice. In fact, look at this chart. It's one of my favorite stocks, this. I'll show you this chart. This is called Silver Bullet Data Systems. Now, each one of these little lines, so a green line means it's a day where the share price has gone up. A red line is a day where it's gone down. So we go back to September or August, it was at 30 pence. Now it's at 171. I invested down here at about 44 pence. It's now at 171. So you can see that's almost, 3 times my money. And so what they do, this is very exciting. I don't know if you know about this, but cookies, as in the kind of cookies that Google puts on your computer, third-party cookies. So when you go on the internet and you're searching for stuff and you find adverts popping up from other websites on your browser, that's through cookies. That is being outlawed this year. Now that's huge because the digital advertising market is massive. It's worth about 700 billion a year. Now, Google, which is the biggest player in this market, have said this year they are going to get rid of third-party cookies. That means it's down to privacy, and GDPR. That means, third-party advertisers can't just follow you on the internet with their adverts. So you think, well, how do advertisers target you? Because normally those cookies are dropped onto your browser and they sit there, but they're not allowed to do that anymore. Not allowed to follow you around the internet. It's privacy. So you're thinking, how do advertisers target you, know what you want? Because you may have visited a Nike store, not bought anything, and gone elsewhere, but Nike know you're interested. So they drop a cookie on your browser and it follows you around, trying to say, come back to Nike, buy a Nike. So now they're using AI. And this is similar but do 4D AI, and it's very clever. So advertisers will go to them and they'll say, which are the best websites to advertise on for, for our customer, and they'll scan websites and pick up what kind of people are looking at what, and they'll contextualize it to say these are the best kind of websites you need to advertise on, and that'll get you the best return on your investment for your advertising. And so it's very clever because it's very cutting edge, and they are signed up to some big advertising agencies. So I quite like that, but it's still a small market cap, and they have results coming out soon. And you have to take into account it's gone up quite a lot recently, so it may have to have a little comeback, pull back, but hopefully the results will be quite encouraging. I think results are coming out in about 2 weeks' time. So yeah, just read, just anything, just to do a bit of investigating, and hopefully you'll pick a winner. But then if you don't pick a winner, then why did that go wrong? And then you learn from your mistakes. And it's a lot better to do that when it's not real money, because when it's real money, it can feel real painful when it goes down. But that's why I think it's good to set up and pretend, mess around with it, take a bit of risk, and see if it goes right or wrong. If it goes right, why did it go right? What did I get right there, and why did I go wrong there? So it's just making it learn. It's a learning process. That's all. Does that help everyone? Any
Yeah,
more questions? Yeah. Any
I
more
definitely.
questions? Cool. Well, listen.
I
Yeah.
just a quick question, if that's all right.
Yeah. Go on.
So I kind of like look on Financial Times a little bit, and there's a thing called forecasts. Could you just
Yeah.
like just briefly explain, because there's like high, medium, and low, and it shows like percentage changes. Could you just like maybe explain a little bit like what those really mean?
Yeah, so this is so look at my spreadsheet here. It's based on a forecast. These are forecasts here, right? So if you get, for example, let's say you have a business, and I don't know what you do. Let's say for example, let's say you're a hairdresser and you want a home hairdresser empire, right? And so you start off with one shop, and basically you're cutting, say 10 people's hair an hour, pretty much. You're charging this much, so you know how much on average you do a week. You can extrapolate that out over the year. Okay. Now, if you own two shops, you assume I can do that in 2 years or double my income. So you're basically, trying to say, okay, I'm say in a week, I say I make £1,000 profit. That's, it's £52,000 a year. You normally put earnings, profit on a multiple. That's how you value a business, because you're talking about, years of profits coming from the next few years as well. So you'd say, okay, so maybe you put that on a multiple of five. So say 50 grand that business is worth £250,000, because you timed in, 1 year's profit by five, because you can assume you can hold the business, because people invest to get their money back over time. It's not, you won't get it back straight away. So forecast, just trying to extrapolate, look into the future and trying to work out how much that business will be worth in the future. And if it's growing, if you're opening more shops and you're getting more staff, and you're getting bigger shops, for example, then of course the amount you sell is going to go up. Your profit's going to go up. So what forecasts are they? They're trying to forecast. It's like a weather forecast. They're trying to work out, what it would be like in a year's time, in 2 years' time, in 3 years' time, how much money you'll be earning, how much the business will be worth, and therefore, how much the share price should be at in a few years' time. So, but like I said, a rule of thumb, sometimes forecasts don't go right. For example, if you started on this business, it's made in the hairdressing business, and you say, I open them shops up, and you think my growth rate is fantastic. And then all of a sudden, you see someone else opening up shops next to you, doing exactly the same kind of business. That'll knock your business, because you now have competition, and some people will go to that shop, especially if they do special deals and all that. So you got to take forecasts with a pinch of salt. They sometimes don't work out, but it's like anything. It's like saying, I can guarantee the weather tomorrow. You look at the forecaster, and it'll be quite accurate for tomorrow. Now, if you looked at a week out, they'll give you a 7-day forecast, but that's less accurate. Now, of course, with it's a lot more predictable with businesses, but the further you go out with forecasts, the less accurate they become. Because let's be honest, the business can change, management can change, sector can change, and more competition can come in. But yeah, there's always worth looking at forecasts, because when you look at those, you're thinking, okay, what's the type of reward I'm looking at here? So if you see a company talking about forecasts and the share price is like, 100%, you think that's good upside. The chances of getting that, I don't know. But if you pick like 5 companies with 100% upside, then there's a good chance that, one will get there, maybe one will exceed that, maybe one will get there, maybe one will just be below. So yeah, it's good to see that. I'm really impressed you're reading the Financial Times. Where do you get that from?
I don't really know. I just made an account like a year ago.
Okay.
And then
Uh,
I've got like a little
our
watch list.
school has a subscription to the
Oh,
Financial
good.
Oh,
Times.
do they?
Okay, good. Yeah.
I'll
Well,
use
look
that.
at that. I mean, you could. I mean, it's worth looking at what's called macro news, which is the big news, that's happening that may affect the economy, and then you have to think about, well, how will that affect the business I'm investing in? But more relevant is learning about businesses, because even if you go to set up your own business, being an investor, that's basically what you are, or someone may have to invest in your business, or you'll have to invest in it. So getting to know about businesses is very handy, whichever walk of life you're in, so so start reading about businesses and stuff, and you think, oh, why did that business do well? Maybe look at them, maybe get books on excellent businesses, and you realize, how did they do that? Like things like Apple or Netflix at the moment, or whatever it is, or Nvidia with AI chips. And you think, well, how did they work? How did that work? And you realize, there's certain things about businesses that do very well. They're very similar. Like they manage to sort of create a little moat around them, meaning that they are special and people want that product, that brand. For example, Apple, very strong brand. If you've had Apple products, you're tied into the sort of ecosystem, but you also don't want to go to an Android phone so much. You want to stay with Apple. So that kind of thing like that. Companies with good brands. But the thing is, if you want to go for smaller companies can grow a lot faster, quicker, but there's more risk because new businesses are more likely to fail than, or have setbacks than older businesses that have been going around for a long time, So, but there's more potential upside to your investment, but more risk. So it's just almost evenly balancing that in your portfolio, having some nice stable businesses, but some growth businesses that bit more risk, So hopefully that's a bit of sage advice for you. Anything else? Lovely. Excellent stuff. Well, it's been lovely to talk to you. And I'm
Thank you
impressed
for
you
your time.
That's all right. I'm impressed you started. This is exactly why I set it up, It's just if it wasn't for my A-level teacher that inspired me back in the day, I wouldn't have such a passion about investing, and I love it so much. Like if I'd even missed that lesson, my entire life might have been different. So it's nice to get started early. And like I said, the only regret I have is I didn't get a decent job earlier to get some disposable money to invest earlier. But nevertheless, I love it, and hopefully you'll catch a bit of a bug, and it'll do well for you over time.
Yeah. All right. Thank you
Thank
very
you very
much.
much,
Appreciate that.
everyone. Thank you.
Thank
Cheers.
you.
Bye
Thank
bye.
you.
Thank
And
you.